Hi, my name's Al Reed, and today I'm joined by Talaria CIO Chad Padowitz. Chad, COVID-19 has caused both uncertainty and loss of income for retirees in particular. Before getting into the detail and potential solutions, can you quickly go over why retirement investing is different?
Sure. So when you're in retirement or close to retirement, the objectives you require from your investments are often different than in other times during your life cycle. And some of those objectives are requiring a sustainable level of income. So nothing linked to the benchmark because you need income to live on. Secondly, the liquidity of your investments. Obviously, if you need the money, you need it to be there when you want it and available to spend. Minimal volatility. The less likely the markets impact your capital base, the better in this environment. And you want to avoid three big risks. Firstly, sequencing, which is the path of returns. It matters a great deal when markets go up or down on your investments. So you want that to be less impactful. Longevity is the second one. If you're going to live to 90 or over, you want to make sure your investments are there to support you. And lastly, inflation, that the purchasing power of your investments doesn't get eroded.
Okay, so what are the impacts, the main impacts to these since COVID hit globally?
Yeah, the main things that have happened from a retiree perspective is income as a source of return has become a lot harder to achieve. And that's because fixed income cash rates, bond yields have come down dramatically, as well as dividend cuts and deferrals are quite prevalent because of the economic impact on companies. Secondly, government intervention has actually impacted the ability of companies to pay dividends, even if they're able to, almost co-opting companies into part of the social support of the economy during this time. Volatility has increased significantly, which obviously impacts the things I talked about a few minutes ago, and that is applied to across asset classes and currencies. And lastly, there's been unprecedented government intervention, which certainly has the potential to impact inflation down the road, which is obviously one of the big risks we talked about.
Just on volatility, how does that potentially affect some of the retirees' objectives?
Yeah, if things are very volatile, the knowledge of what assets you actually have and what they're worth changes all the time. So your ability to live comfortably in retirement is more impacted. It's also more difficult to know if you are living off capital, when to sell and not to sell, because things are moving around quite a bit. So volatility is just a very uneasing and challenging environment to be in retirement and having assets that are exposed to it.
So what can retirees do now?
Yeah, I think you need to think differently about diversification, not just at the asset class, because they're all troubled, but also of the process about how you actually earn your return. Having an income source that's just relying on dividends or rent or property yields or fixed income in the current environment is actually likely not to get the objectives you require, and the risk you will take to try and get it that way is very, very elevated. So, having an income source that's not reliant on dividends, one that's less volatile, one that provides lower downside protection, and by that I mean if markets drop, you share a lot less of that, which is obviously very important. So that in periods where the market is volatile, or certainly during your retirement years, you can have a far smoother journey. So I think retirees have to ask themselves, what are the things they need to pay for a certain lifestyle? What obligations do they need to meet? And how can you achieve that from the portfolio that can give you more certainty?